Ajay Srivastava joins us now. Let's take a conversation forward. Ajay, good morning. Thank you for joining us. Ajay, August and early part of September have been more than satisfactory for everybody. Now, nothing has changed in terms of the big picture on the Fed, locally, and also on the medical front. If at all, on the medical front, things have gone, they've slipped slightly. But yet, markets have registered double-digit gains. Why?
I think, Nikon, good morning. One of the key things has been that the continued retail participation. I think that's what has given the edge to the market that whenever there is some, at least some pressure, modicum of pressure on sales coming from institutions or mutual funds in some order, and it has been lapped up by the retail public. So, this is a very peculiar time frame that we have seen that there's been no major institutional presence in the market in terms of incremental investment. There's been a churn, of course, but the fact that the retail has come and picked up the stocks directly. They don't have to go to intermediate to mutual fund. They're not going through anybody else. They are picking it up. So between PMS as well as retail funds, I think that's where the big pickup is taking place. And it's kind of it's important because I think most retail public are now trying to build back equity into their portfolio. It was primarily real estate, fixed income. Now we're seeing systematically retail is building up equity. So and that's being a good base. It's true for India. It's true for the US. It's true for everywhere. Institutional action is more in the private space, retail action is more in the secondary space.
Ajay, in the historical benchmark is that when there is activity in the IPO market, it's dangerous. When there is participation by retail folks, it's dangerous. And when we have both, it is time to get out. But somehow the historical logic this time has not translated into reality. Why is that?
I think three reasons. One, the fact that the history in the last 3 years has shown that buy on dips has been a very good strategy for most retail public. And the biggest example, of course, was March 20 when the sell-off happened, and what recovery after that. So the recent historical memory shows that buying on dips is a very good idea. Given also the fact that retail public in India is largely underinvested on equities. If you go around and talk to people, their equity portfolio would not be only 5% of the net worth or maybe maximum 10% of the net worth. That's it. So there is a large gap in their equity portfolio. Number two, buy on dips has been very profitable. That's one. Number two is, the real action in this space is coming from, as I said, is from the space which is the private equity space. If you look at the valuation of private equity space, that far exceed anything in the space of the secondary listed market. And therefore, till that thing doesn't disappear, I will see this market being robust. The real trigger for the correction would happen only and only if we see a dramatic slowing down or valuation slowdown in terms of the private space. Private equity space has to slow down, and that will trigger what I think is going to be more reasonable pricing in the market. Most stocks are, the known undoubtedly have expanded and a PE multiple way beyond they should be. That's true. But I think the trigger would come only when the private equity space, either valuation or the gush of money slows down. Once that happens, we will find a lot more normalcy coming in the system. But till that liquidity flow is supporting the private space, today listed spaces are actually cheaper than the private spaces for most companies.
Hi Ajay, this is Mubin as well joining in. Now it looks like those steep valuations that we are seeing in the private equity space may soon be entering the Dalal Street, with what unicorns now riding over to the exchanges to list themselves, thus giving these PE guys, an easy exit option. So loss-making companies are still, quoting at these at the prices. We're seeing Zomato. We'll probably see many more companies now list over the course of the next couple of months. So, do you think then that that whole high valuation phenomena may come to the Dalal Street as well now, which seems to be very likely?
Zomato has shown us a lot of us skeptics as to what will happen to the post listing, and it's maybe still too early. Perhaps it's been a month only to see how the experiment works. But the fact is that the companies coming to the market have got a scarcity value. You don't have a Zomato. If a Baiju today, on a turnover of what 2,500 crore is valued at 1,20,000 crore. Now that for any metrics of common sense would have told you it's ridiculous, absolutely. But the fact remains that these are scarce equities in the market. Therefore, if an edtech company comes to the market, it'll be the first perhaps company to come to the market after the debacle of two other education companies which have Zealand, etc., which have not done well for the investor. But that was some history 5 years back. But the fact is, these companies are driving scarcity value. But again, the key point of the IPO is that their ability to place blocks of shares to another institution. If a PE fund wants to get out of 1 million shares or 5 million shares or $2 billion, they're not going to get retail to buy those shares. They're going to have to get an institution to buy the shares. And that's where the phenomenon comes that if that play stops or slows down, then you'll see the rapidly dominoes moving in towards the valuation. I'm not saying a major correction, but certainly the euphoria that we see, the valuation multiple that we see today, I think they're just crazy, but the liquidity flow is just keeping it going in a manner which you're not even understanding what's happening in the space. So yes, it will shift to the IPO space, but Indians will lap it up because we do not give a scarcity value. You've seen the ferocity of buying in an Apple or a Google, etc. In less than a year since people discovered the way to buy foreign equity. You saw almost how many $1 billion is now pouring into those stocks, and those stocks are relatively much cheaper than Indian stock. So that tells you there is money in the system, there's money in the domestic market. Nobody wants to do business in India. They all want to put equity in the market at this point of time. And therefore, the flows will continue to give you the benefit of it. Now, if you're a long-term investor and you've already seen sensible investors moving a lot of money to consumer stocks because they know no matter what happens, 10 years down the line, Hindustan Lever will still give them a good 20 to 30% rate of return, or a Nestle, or a Emami, or a Dabur, etc. And that's where you see the moment the market gets frothy, there's a lot of movement to IT and consumer, because that's the defensive plays in the market to balance the volatility in the other part.
When, what do you think could be a sign of liquidity, that liquidity gush slowing down? We had the US and now perhaps the ECB as well talking about taper. I mean, we'll know from the ECB later today evening. But could that be, a sign of withdrawal of liquidity, which has primarily, of course, been boosted because of the very loose central bank monetary policies?
Not only loose central bank policy, I think there is so much of leverage in the system. That fact that the private equity funds are now, earlier they used to invest customer money. Now they leverage customers' money. So if you see the latest deals done in India, you have seen private equity fund themselves now starting to leverage their investment 2:1, 3:1 to juice the yield. And that's the dangerous part, that if this starts to happen, but when it will happen, will it ever happen? The kind of hold the capital markets have to blackmail central government, will it change? One doesn't know. But the fact is that first the leverage has to go down in the system, where the private equity funds have now started to lever the market, and then we should see some slowdown in this valuation multiple. And we have seen that. And I'll give you an example. Two or three large deals, whether Suven or Granule, etc., did not go through in the pharma market, in the private space. They had to be sold out. Although they're listed stocks, they needed to be sold out 100%, promoter holding. The deals couldn't go in the market. And you see the rest of the valuation of the pharma industry. It's not picked up after the debacle of last 6 months, with two or three major deals falling apart. Suddenly you see the whole sectoral re-rating happening in terms of market. So it's going to happen. When it's going to happen, I do not know. But at some point, it's going to happen that the private equity space will start to slow down, at least first start not to lever, and then start to slow down on valuation. And that will move to this market. But anybody's guess when it will happen. But certainly, we have seen it happening sectorally in India and the pharma industry.
Ajay, I was just looking at what's happening on the NASDAQ, and I mean, you've got Apple and Microsoft, which are already trading at that market cap in excess of $2 trillion, and now Alphabet as well is catching up. It's just shy of, that mark. And I was just looking at the year-to-date moves on some of these global stocks. I mean, 17.5% move on Apple with a market cap of $2.5 trillion, 36% uptick on a Microsoft, Alphabet holding up 64%. I mean, it's not a peer-to-peer or an apple-to-apple comparison comparison, but just wanted you to draw a correlation as to what's happening within the Indian IT firms as well. Because much like some of these global names, Indian IT as well has only been going from strength to strength. After just one day of a relative underperformance, when I think we made it to 17,000 or 17,100 thereabouts, the sector continues to charge ahead, and any parameter talking about valuations being right, price to perfection, etc., are not really holding true for Indian IT names as well. Do you sense IT is going to continue to be this, mega compounding story which will continue to augur good returns for investors?
I think first thing is, you're talking about the increase in Apple and Google and Alphabet. Just watch till the Indians have just not even landed there. The Indian investor has just about dipped its toe in the market. You're going to see in the next 2 years what's going to happen to some of these stocks. It's going to be, and it's not going to come from the US alone. It's going to come from India and rest of the world, which has now started to feel that why were they left out in the rally on the biggest stock. So very clearly, there is a huge traction on the buy side for all these stocks from global investors and Indians in particular who have been kind of now wanting to do it and get into involved. So one is, these stocks have, again, back to the point, have got enormous value in terms of the demand. And number two, none of these stocks issue equity. They mostly do buyback. So the supply is also not increasing the market. So you can imagine when Indians start to go invest, 200 million Indians suddenly start to buy Apple, what's going to happen to the stocks? So that's the parameter on which you must look at some of the valuation of these stocks. Now, Indian IT industry, to be honest, the fact was it actually went through a literal wall of worry and ignored. This industry was totally ignored by most investors at this point. 1 year back, if you see portfolio, they didn't have too much of IT, did they? Not too much. It is only people like Aberdeen, etc., which are holding IT stocks for, I think, 20 years or whatever it is. So first is that the re-rating happened because people decided to move to IT. And I think that was what happened in the last 6 months. Now are the people who are the late converters who are wanting to buy into, again, on the same story as the consumer. So listen, market can go wherever they can go, but these stocks have an ability to keep bouncing back. That's one. They operate in the best global market of the world, which is the United States, and therefore US growth rate is critical to them. Most of them operate in 2 or 3 sectors, banking, etc., which has kind of been the bulwark of keeping this company going. So the parameters are US growth, IT investors, and the fact that they are almost mimicking, in a way, they're mimicking a consumer kind of a company, which is regular growth, regular income, and so on and so forth. So I think this traction will continue. Having said that, they will face I think in the next 12 months or so, they will face a little bit of trough because the rupee dollar, the way it is behaving itself, is not going to give them the 3.5% depreciation. That's what has happened. Rupee went to 75, back to 72.5, back to 73. So that variation is going to take away a lot of profitability from these companies. So people who are entering now are going into a little more volatile period for the IT stocks. Unlike an Apple or a Alphabet or these stocks which don't have this volatility on their books, Indian IT companies have rupee dollar as the savior for the last 15 years. Now, if that doesn't become the savior for the next 5-7 years or 2 years at least in a short term, therefore, the volatility in prices would come and you will see underperformance of the sector. We believe in the next 12 months, IT will underperform rest of the market. And therefore, it will still perform perhaps, but it will definitely underperform rest of the market given the way rupee dollar is behaving.
So where else can we see this kind of a large disruption play out? It's not really, again, the same kind of a parabolic move that we've seen so far, but something large is afoot within the entire real estate package, and we've often spoken about this as well. Everything from realty demand to the ancillaries of building materials, home improvement sector, that is also seeing a big boon come in.
I think, the developers have never had it better than this for the simple reason that now there are only 8 to 10 developers in the market whom people trust with their money, given what's happened to the rest of the developers. And therefore, they are enjoying a boom of the market. And the reason they're enjoying the boom is not because just consumer, but also because they are able to offload their commercial spaces to the REITs. That has changed the dynamics because you saw what happened to Prestige. They offloaded the entire portfolio out, got the liquidity, and now can put the liquidity to start 10 new projects at this point of time. That is what they change the dynamics for most of real estate players to know that they can build commercial, make reasonable profit, but keep selling it. And I keep saying to that every single growth economy in the world, whether you look at Singapore, Hong Kong, or at least these two large examples, real estate companies were a large component of the indexes one point of time. India has not seen it. Perhaps India will see it now when the top 4 or 5 developers will, I believe, offer a multiple bagger investment opportunity even from this level. And it's very visible, it is very clear, but there is a lot of skepticism because, black, white, there is a lot of baggage in people's mind. But that is true for this industry, that is true for steel industry. I think these two industries, to my mind, will get re-rated in investors' mind and will acquire traction and offer the best multi-bagger opportunities, if you ask me, in the sectors. And relatively, they should outperform everybody else in the market.
Well, Ajay Srivastava, appreciate your time. Have a lovely weekend. It's a long weekend this time, and it's a long weekend after a change. So thank you very much for joining us.